Hello and welcome to the eValue April Market Evaluation webinar. These webinars are hosted each quarter to provide an update on what has happened in financial markets over the last quarter and how those changes affect the expected returns and portfolios that are updated each quarter based on the eValue asset model Insight. With me today is Salman Ansari, a senior member of the eValue asset modelling team. First, we will look at an overview of eValue's approach to asset modelling before Salman covers the latest developments. The eValue asset model, Insight, is an economic scenario generator. That means it creates thousands of different economic scenarios which all work out how markets develop over time. These scenarios are used in tools for projections so that people can understand the risk and reward of investments. It gives the possible outcomes for various financial decisions, and that's what we build the asset model for. We've been using an economic scenario generator since 1993. We have over 20 years of experience. We also make sure we stick to a medium to long-term perspective and not look at individual short-term tactical decisions. The reason for that is to make sure we aren't looking at one particular issue and instead look longer term to make sure that the overall results are looking sensible. For example, there are low interest rates at the moment, which would imply low returns for bonds. However, if rates stay low, that could actually mean that bonds are an okay investment after all. The key requirement for any model is that it is fit for purpose. You have to understand what it is you're trying to use a model for and to make sure it can meet those requirements. So for us, it's for looking at the outcomes for investors at the end of an investment term, to making sure that they can make their financial decisions correctly. And that is also needed in today's terms, adjusting for inflation. That means you need to make sure you also model inflation in that. We also need to take into account both income and capital, and what we do then is combine those to give a total return for our forecasts. Investing is generally an immediate option. You'll be looking at investing now for investors. That means we need to reflect those economic conditions that are as at now, but also look forward to what could happen in the future. And that's not just about the UK. We create a global model which covers multiple currencies. We also take into account the fact that there are different time horizons for various investors. For example, a cash would be a sensible short-term solution if you're looking to not have any fluctuations, but in the longer term, there could be a potential for using a bond in a similar situation. The model structure itself is made up of economic variables, which are shown here on the left-hand side. We build it up from government fixed interest, nominal and real interest rates. The difference between those gives you inflation, and from that you can then create the asset returns you'll see on the right-hand side. In addition, there are a number of other elements which get added into the model, such as equity dividend yields, property rental yields, and various currency interactions. We create four major currencies in US dollars, pound sterling, euro, and yen. From all of those economic variables, we then create the asset returns you see in your forecasts. The asset model concepts build up from the model calibration of those economic variables you just saw. And what we do is produce a year-by-year forecast where each year depends on that starting point. So as the economic variables move over time, what you find is that the variation in the following year depends on where you started from at the beginning of that year. And as a result, we also need to make sure that we update the model quarterly, because we need to have that very first starting point from which all the other starting points are created. That then produces the simulated scenarios, which helps us describe how the economy might move over time. Which leads me nicely in to hand over to my colleague Salman Ansari to talk through the changes in the quarterly calibration and their impact on the expected long-term returns and portfolios.
Thank you very much, Andrew. In this part of the webinar, we will look at how the economic indicators have changed over the quarter and how these changes are reflected in our asset model in the form of changes to the asset returns. We will also summarize what has happened so far this year and say a little bit about where we think it's going next. So we'll start with interest rates. As we have noted, interest rates are the cornerstone underpinning asset price movements. So we'll start with these and then move on to the other assets. The year and the quarter started with oil and share prices collapsing while bond prices soared. But since then, oil and share prices have recovered, but bond yields remain low. This was not the prospect contemplated at the end of last year, when the US Federal Reserve raised interest rates for the first time in almost 7 years. Not long ago, there was talk of the Bank of England raising interest rates, before the Fed even, but over the quarter, this has been pushed back. Some analysts are now even pushing for a UK rate hike beyond 2017. In any case, whenever that move happens, it may be more to do with a finely balanced position than with a big movement in the real economy. To get there, the UK economy faces many obstacles. There is anemic growth abroad, slowing domestic economic growth, and resolutely low wage growth. And currently, the uncertainty and possible disruption of Brexit has also been added to the mix. While UK unemployment rates have continued to decline, US jobless rates showed a surprise increase this month, all signaling that the current low rates will likely stay put, at least in the near term. So let's have a look at interest rates. Rates in the UK and US have been firmly on a decline since the beginning of the quarter. There was a notable dip in the first half of February when panic of an impending global recession took hold in the market, especially in the Far East, and investors flocked to safe havens, raising bond prices and thus decreasing bond yields. Japan has had an unprecedented quarter. Its bond yields have, for the first time, veered into negative rate territory, after showing a similar decline in rates as the UK and the US from its already low levels. The short end of the Japanese sovereign yield curve is now firmly negative. This is new for this low rate economy, but is hardly unimaginable given the prevalent negative rates already seen in several European countries, notably Switzerland, Sweden, and Germany. France and Germany have mirrored the trend seen in the UK and US with respect to rates, but at a lower level, with similarly vacillating yields over the period. Italy and Spain also continue to follow suit, and their yields have ended the quarter close to UK levels. Greece continues to remain an outsider, and the rates there have had a particularly tumultuous quarter, with 10-year yields exceeding 11.5% at one point. These sort of levels were last seen about a year ago, when Brexit fears were peaking. Somehow, Greece has avoided much media attention so far this year, but recent failures in talks with creditors, notably the IMF, means Greece is again heading for a default this summer. So watch this space. The upshot of all of this is that lower rates make our projections for fixed income returns lower. And even though our projections show upward movements to be more likely than downward ones, they do not suggest that bonds are a one-way bet by any means. With another major developed economy, Japan, having joined the negative rate club, if deflationary pressures continue, it may only be a matter of time before the notional floor at 0% is breached, and the UK and US also follow suit. We'll next look at real yields. Note here that the vertical scale is reversed, so lower is more positive. Real yields are still firmly negative and have become more so since the beginning of the quarter. The macroeconomic meaning of these negative real rates is that there is either the expectation that nominal rates will remain low or go lower still, or that inflation is expected to rise faster than nominal yields. or perhaps even some quantitative easing is expected, or a possible combination of all of these. In any case, the pressure on inflation rising remains low and is only helped by the still low oil prices. This means that real returns continue to be hard to come by, and prospects for index-linked bond returns at the quarter end are worse than they were at the start. Next, we will have a look at equities. There have been two notable dips in equity markets, mostly on the back of Chinese market routes in January and then later in February. The first collapse coincided with oil prices plummeting in January, whilst in February, Asian stocks tumbled amidst fears of a new global recession. Volatility indexes shot up, reaching the highs seen last year during the massive correction that happened in the Chinese markets at the end of August. Since then, markets have staged some sort of a comeback, and some measure of calm has been restored, as we shall see from global volatility indexes later on. So if we have a look at the chart that's on the screen right now, the FTSE 100 has rallied since the dip in February to end the quarter slightly below where it was at the beginning of the year. However, it is still far below the peak reached last April, and the levels we're seeing currently were first seen almost 17 years ago. So there is still work to be done. The US stock market has moved almost in step with the UK, regaining ground lost amidst the tumult at the beginning of the year. But it remains sensitive to global market pressures and price movements, and finished the quarter slightly higher than where it started it. While the UK and US have recovered from the collapse in markets earlier this year, the Eurozone and Japan have been less successful in doing so. Both have ended the quarter significantly below previous quarter levels, and Japan in particularly has taken a big hit. Asia Pacific and emerging markets reacted better than the Eurozone and Japan, and have ended up at the end of the quarter. Emerging markets most of all. EM equities have in particular been helped by large gains made in Brazil, where gains of the order of 35% have been seen over the quarter, and South Africa, where gains of about 8% have been seen. Having said that, the rise is not strong, and there are large and obvious risks in some significant markets. Brazil, for example, still faces severe challenges. Even so, the outlook of emerging markets is more positive than everything else, and this is reflected in our asset returns projections, as we will see later. We'll next move on to exchange rates. Stock market movements that we've shown so far have been in the local currencies. To see the effect on, say, a US dollar investor, we should look at these stock markets in a common numeraire. So let us first have a look at what exchange rates against the dollar have been like over the period. Note here that we are showing exchange rates relative to the values at the start of the quarter and not actual exchange rates. The US dollar has strengthened over the period, while the British pound has simultaneously weakened, which means that the US dollar investor has a favorable exposure to downside movements in the UK, but realizes less return should UK markets gain. While Brexit fears have made a contribution to the weakening sterling over the quarter, a major factor is the UK current account balance, which is deeply in the red and is at its highest peacetime level. With respect to the euro, the US dollar has weakened over the quarter. So now if we have a look at the same equities that we did so far, but in US dollar terms, the story is slightly different for some of the economies. Since the US dollar strengthened against the pound, UK equity returns appear slightly subdued. But the weakening of the US dollar against the euro and the Japanese yen means that the negative price movements in those economies were less dramatic for the US dollar investor. So the upshot for equities, therefore, are deteriorated asset returns prospects over the quarter, least so, and by some margin, for emerging market equities. This is also a good place to say something about property. Property assets have improved quite markedly over the past year, ending last year on a high. What this means on the flip side is that their prospects for the future are relatively subdued, as much of the yield has already been realized. Before moving on to asset returns prospects from our asset model, we'll mention a couple of interesting artifacts of the economic environment we see today and what bearing they may have on what's coming next. First of all, is Chinese equities. In China, growth is slowing, manufacturing is seeing a mild contraction, and activity indicators show a decline in industrial production. Global commodity demand has dropped as a result, as also highlighted during the recent Tata Steel saga that has been gripping the UK. Despite this, market movements in China have been responsible for all major crashes in global equity markets in the past year, stressing the influence of this global powerhouse. So future movements in China are likely to have profound effects around the world in times to come. Another interesting indicator is equity volatility. We showed these indexes in our previous webinar at the start of the year as we were passing through a peak similar to the one seen last August. Since then, there has been a further peak in the beginning of February, much bigger than the previous one for some economies. Volatility indexes are a posteriori indicators that reflect market anxiety. So whereas the UK and US appear to have returned to nominal levels, Japanese equity volatility is again on the rise, signaling that there is growing anxiety in that market. So the outlook at best looks a little uncertain. We'll now move on to asset returns projections from our asset model. The main take-home from the discussion thus far is that prospects have deteriorated over the last quarter. Equities have still not really recovered from the collapse back in August, and between lower prices and weaker growth, their outlook is little changed. In relative terms, emerging markets have made the biggest comeback, and we expect to see a shift towards them in asset allocations. Declining rates and low inflation pressures have depressed fixed income returns. Outputs from our model reflect these observations in the asset returns projections. We will demonstrate these by way of tilt charts like the one that's on the screen right now. These tilt charts show the change in asset returns over the quarter at various time horizons. A movement to the right indicates an increase in risk, while a movement upwards indicates an increase in return. So the best improvement would be in the top left quadrant, where we'd be getting more return at the cost of less risk. So at the relatively short time horizon of 8 years, most asset returns movements are in the bottom left quadrant, showing a decrease in risk at the cost of an even greater decrease in return. The exception is equity market, the emerging market equities, which show a very slight improvement at this time. Cash is the least unattractive of the remaining assets, followed by fixed income and then the remaining equities. Property in particular has taken quite a hit this quarter. If we look at the longer term, say 18 years, all asset return movements are in the bottom left quadrant, showing much larger decreases in asset return for decreases in risk. The relative performance of the assets are similar to that at 8 years, with emerging markets again performing best. In summary, we'll have a look at how the performance of asset classes has changed over the quarter and more generally over the past year. Asset classes have performed in a vacillating manner over the past year, but since the start of this year, all prospects have worsened. Emerging markets are the most volatile, but have ended up with relatively the least declined performance in recent months, making them relatively more attractive than the others. And that brings us to the end of the asset returns summary for this quarter.
Thank you, Salman. That's very helpful. You did mention the Brexit. We've had a question come through on the Brexit. Do you have any feel what the impact might be?
Yes. We envisage a change in the market conditions after the referendum. So whichever way the referendum goes, the markets will have positioned themselves somewhere between the two possible outcomes. So as soon as the vote goes through, we expect to see a sudden change in market conditions. And in terms of our client portfolios, we expect to update our client portfolios immediately afterwards. So they should be updated very soon thereafter. As regards to Brexit itself, the odds have reduced in recent weeks, especially since the US President waded into the debate at the weekend, and we've actually seen a 6-week high of the sterling against the euro this week. So the best advice is to watch this space. Thank you.
Thanks, Salman. And that brings us to the conclusion of this webinar. Thank you very much for your time, and we look forward to following up with another one in a further quarter. Thanks very much, everybody. Thank you.